IndiaMART currently controls 60% of this market. Their network serves 42 million active buyers and 222,000 paying suppliers. Management guidance for FY27 reflects a focus on steady, disciplined expansion. They are targeting revenue growth between 10 and 12%, with operating margins expected to remain stable at approximately 33%. While this network moat is stable, it has stopped widening at the bottom of the pyramid. With volume growth stalling, the company is being forced to find a new engine to drive its next phase of growth. This analysis from Tajori AI illustrates the core thesis. IndiaMART is moving from a volume-led story to an ARPU-led cash compounder. Future growth now depends on extracting more value from the existing user base. The foundation shows signs of stress in the silver tier. High churn rates among these entry-level subscribers have caused total paying supplier growth to slow to just 2% year-over-year. The economics are increasingly concentrated in the penthouse. The top 10% of users in the gold and platinum tiers now contribute roughly 47% of total revenue, making ARPU expansion the primary driver of the company's valuation. This chart confirms reliance on higher value services. Q1 FY27 consolidated revenue reached 414.40 crore rupees, up 11%, with web services growing 8.55%. Profitability recovered. EBITDA margin rose to 35.36%, supporting a net profit of 172.20 crore. The quality of the order book remains high, with deferred revenue growing 16% year-over-year to over 2,000 crore rupees. Margin stability now depends on the company's ability to successfully upsell its premium tiers to a captive audience before those users churn out of the system. A forensic audit of the balance sheet reveals a stable baseline. With a market cap near 12,500 crore, the stock trades at an EV to EBITDA of 25 and a PEG ratio of approximately 1.6. Capital efficiency is a hallmark of the core business. High ROE and ROCE figures are supported by a balance sheet with zero debt. The subscription model creates a highly favorable working capital cycle. Because fees are paid up front, the business generates significant cash, efficiently converting net profit into free cash flow. This cash generation provides a long-term lever for growth. By focusing on multi-year package renewals, the company has a path to grow free cash flow at a 15% CAGR. This chart shows a significant shift in who owns the company. Foreign institutional investors reduced their stake from 27% in 2021 to 19.17% by March 2026. Despite this rotation, promoter holding remains exceptionally stable at exactly 49.12%, with zero pledged shares. Regulatory risks have been manageable, such as the 8.5 crore rupee one-time impact from the new labor code in late FY26. Auditor fees have historically scaled in line with revenue and profit growth, suggesting no major forensic anomalies in the financial reporting. The core classifieds business is mature and slow-growing, though it remains a stable source of cash. This transition reflects a management team looking for a faster engine, even if it means entering higher-risk markets. The pivot is now official. The board approved the incorporation of IndiaMART Finance Limited, a subsidiary designed to provide working capital directly to platform sellers. By moving from discovery to end-to-end commerce, the company is addressing the primary constraint for small businesses, the need for credit to fulfill orders. This data from HDFC Bank shows the metrics that will now define IndiaMART's success. Investors must transition from evaluating subscription growth to analyzing banking performance. Like any financial institution, IndiaMART Finance must manage the spread between interest income and the inevitable cost of bad loans. These asset quality metrics from ICICI Bank highlight the benchmarks for the lending industry. The new subsidiary will be judged by its ability to keep non-performing assets low while generating a return on equity that justifies the capital at risk. This data from Axis Bank emphasizes the regulatory requirements that come with lending. Unlike a software platform, a lender must tie up significant capital to meet adequacy ratios and maintain provisions for potential loan losses. This NBFC arm introduces a different level of balance sheet risk. If executed well, it could turn a slow-growing directory into an inescapable financial ecosystem for Indian small businesses. This technical chart overlays IndiaMART's price action with its 20, 50, and 150-day moving averages. The 150-day line currently acts as a key technical indicator, helping to define the long-term trend and identify potential support levels during pullbacks. A recent close at 2,098 rupees shows the stock consolidating within its broader range as the market weighs the core earnings against the new fintech strategy. Compared to peers like Just Dial and InfoEdge, IndiaMART trades at a multiple that reflects its strong cash flow, but also the reality of its decelerating user growth. The technical momentum currently aligns with the fundamental transition. The market is holding steady, waiting for clear evidence that the shift toward ARPU and lending will actually deliver the promised growth. Based on management's FY27 targets, we can model 3 distinct scenarios for the company's future value. In the bear case, churn in the silver tier spreads to higher tiers, while the NBFC struggles with bad debt from small businesses, stalling the ARPU expansion. The base case assumes the core business achieves its 12% growth target, while the NBFC scales at a moderate pace without compromising capital adequacy. The bull case sees rapid ARPU growth through software integration and a highly successful lending arm that drives a massive increase in transaction volume. The central question for investors is whether the current price provides a high probability path to a 15% free cash flow CAGR over the next 5 years. Considering the forensic stability against the significant execution risk of the new NBFC, the investment verdict is a hold. The market has yet to price in the potential volatility of the lending business. IndiaMART's trajectory serves as a test of whether a tech leader can adapt to the harsh realities of banking and credit. The investment case has shifted. It now rests on the disciplined execution of a financial ecosystem rather than the simple growth of a digital portal.